I had a very successful event in Singapore. I was there for 10 days. A lot of you showed your affection on me wherever I went, whether it was the streets of Singapore, whether it was at the restaurants, the malls, and more particularly at the events. I wish to thank all of you from the bottom of my heart. My team felt that I had never done a full fledged event in Abu Dhabi, and they wanted me to do so because we have a lot of friends there. So the next event would be in Abu Dhabi on the 5th of October. Those desirous of participating in that event, drop a message at the WhatsApp number given below or send a mail at the email given. My team will get in touch with you.
Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
Hi everyone, welcome back to Be Rich. Yes, today's topic is going to be interesting because one thing a lot of you have been wondering about is we always talk about FIIs and DIIs and ownership and the influence they have in the market. So by end of this video, you will have some new revelations you will understand, and you will understand the implications of this change in the paradigm. So let me discuss this in greater detail. Historically speaking, when the Indian markets opened up, Indians unfortunately did not have much money. So most of the investment which was rolling into Indian companies were from offshore, meaning foreigners, foreign investments. They could be foreigners of purely being foreigners, or they're Indian origin foreigners who are investing in our equity market. And because of the arbitrage of the dollar and the rupee, a lot of them brought their money into India, and especially during the times of zero interest rate, it was a great opportunity to make a good spread between borrowing it at no cost and investing it in India and taking back some cash as the Indian economy and the markets were growing. And this has been historically very true. And the influence they have exerted on the Indian market for a long time historically has been well documented and spoken about. But as this has been happening, we Indians have also been growing, not only in terms of our population, which is news to all of you, I'm sure, but we have also been growing economically, and we have been growing financially, and we have grown in numbers of investors. Our retail investors are very small, and I've done many videos about it where we have been small. But the retail investors have not been growing in terms of market percentage. The DIIs in India have been growing in terms of market percentage. Who are these DIIs in India? Well, we have government, which is a DII. Then you have insurance companies who are DIIs, like your LICs. Then you have pension funds, which are DIIs in India. Then you have high net worth individuals in India who are smaller than the DIIs, but because size compared to retail investors, they are pulled into that because of the size they can exert. I mean, the amount of money they have, they also exert some influence on the Indian market. So as FIIs have been getting nervous over the last decades, whenever those moments came, the DIIs always stepped in and saw the opportunities and have been buying. So this imbalance has been going on. So though we've seen those periodic times when Indian markets really crashed and corrected, those have become less and less, if you noticed. Our markets are looking more and more stable. So especially when you see news like the American market corrected today by 3%, 4%, then you expect the Indian markets to follow suit, because foreign investors will also be pulling money out of the Indian markets. We turned on and we see the market is quite sanguine, and meaning it's not reacting, it's taking the negative news positively, and it's not, though the indicators as we see and we analyze look negative, they don't seem to be moving. We don't see the Indian markets crashing. And a lot of you are wondering, why is this? Why? Well, the reason why is because we have been saying that domestic investors have been stepping inside and they've been buying. And this has been going on for quite some time. To the point now, I can tell you, as of this year, of March 2024, in a published article, I'm reading the Indian DII is holding as at 18.4%, where the FIIs have slipped to 17.9%. That means DIIs have overtaken ownership in equity shares in India ahead of the FIIs. This has various implications and factors to consider as retail investors in India. So what does this mean? This means the surge of inflows we've been seeing, the new SIP accounts which are being created in India, which we spoke about last year and we've been talking about this year. All those SIP accounts have contributed to these mutual fund houses in India starting to wield enormous influence in our markets. What does this mean? This means a rising household savings in India, instead of being in deposits, which we have historically seen, have slowly moved into our equity markets. And you've done many videos where we have told you about how the banks are suffering because deposits are not coming anymore as they used to freely as before, because most investors and households in India, especially the middle class sector, have been keen on participating in this market rising in India. So this has led to exceptional investment happening through our mutual funds, through SIP accounts, and DII is becoming larger and larger in India. So what is this changing market dynamics and trading pattern give us? Well, what it offers is it offers a much more stable Indian market. Stable in the sense of the FIIs having influence in Indian market has become more and more smaller in terms of percentage compared to what it used to be. So gone are the days when we're going to see tremendous shifts in Indian markets because FIIs are pulling out tremendous amounts of funds and crashing our market, and we are sitting there and wondering what happened. So those opportunities may be far and few in between if you are a value investor waiting to sit on hoards of cash and to move in when you see the market crash. We have had those opportunities in the past, I agree. But going forward, are we going to see those kind of opportunities? Yes, but not as often as we used to. Maybe individual shares, company shares may have this kind of an effect. But overall, broadly, the whole market moving in swing, in tandem, may be not as often as we see it. For example, let's say the market opens and we see an immediate sale, fire sale happening from the FIIs, and the market drops by a percentage or two. Within a few hours, our DIIs will usually wake up and you'll slowly see the market being pulled back. Yes, we can be cynical in saying it is the government doing this or whatever you wish to say. But I would like to keep politics out of this, and I would like to stay neutral as much as possible and look at it purely as an investor looking at opportunities to create wealth. So yes, private promoters shareholding in India stands at 32.7%, while the government ownership in Indian companies have risen to 11.2%. So the market is overall much more stable compared to what it used to be in the past. And you're going to see this kind of pattern going forward. So as investors, value investors, what does this mean? Retail investors. Well, as retail investors, I feel you will have to look harder and deeper and better eyes for those opportunities in the market, to find those values in the market. Because as values appear in the market, you're going to find more and more DIIs moving in swifter and faster than you. So is it advisable to hold on to a war chest and wait for the market to correct and then you're going to drop it? I would beg not to think that's a good idea. Because the reason I would say it's not a good idea is timing such markets are going to become even harder. Because you waiting for, let's say you see the market fall by 1% or 2% and think, okay, today it's going to stay down. By the end of the day, the DIS might have pulled it back up. Meaning they would have seen the value and they would have decided to move in and take this value at this point instead of waiting for it to correct further, because they have their own pressures to meet. So keep this in mind as a retail investor. Look for opportunities. And if you find an opportunity which you feel is fair, I would advise you to start looking at it in Tiffin coffee ranges, instead of hoarding cash and thinking, okay, it's going to drop by a huge bomb and I'm going to get inside and sweep it up. Yes, those tools still may happen. I'm not saying they will not happen at all. I'm not saying that. But it used to be far more frequent, these opportunities, where we saw the market being volatile, as they say in India. But with the DI's presence and stronghold increasing to this level, so I would say our markets are far more stable. So as an investor, it is great news. At the same time, it's not so great news. In the sense that if you're waiting for opportunities and you're waiting for these huge market corrections, they may not happen as soon as you want them to happen. Do remember, money you can have, wealth you can create. But there's one thing you cannot keep getting back, no matter what you do, no matter whom you are. Even Warren Buffett can't get this, and he has said this in a video about his 94th birthday celebration, that this time, you cannot get back time. Even Warren Buffett would love to have some more time. All of us have an allocated amount of time on this planet, whatever your religious belief is and whatever you think of afterlife is, but you can't take anything with you. So do remember that to spend your time wisely, invest smartly, and to keep going. So thank you for watching this video. I hope you found it informative and entertaining as always. I've tried to put all these points down together in an article and drop it on my Medium page for a change, which I haven't done for some time. So if you are inclined to reading, I do suggest you go there and have a read about what I've said over there, and do drop in your comments over there or over here, or you can reach out to me on Instagram, and do try and join my 52-week challenge on Instagram. Join the community where we're trying to learn how to invest better and to create our own patas list, as you guys like to call it. And I'll see you in the next one soon. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.